Something pretty big is happening in the Sri Lankan stock market. There's a major rule change going on, and it's a really strategic move to fix a problem that's been holding back an otherwise booming market for a while now. So let's dive in and break down exactly what's going on.
So if you just look at the surface, Sri Lanka's stock market looks absolutely on fire. Last year, its main index, the ASP, jumped an incredible 41.7%. I mean, with a number like that, you'd think investors would be popping champagne, right?
Well, here's the catch. Behind that massive number, there's been this fundamental issue that's been really frustrating investors and honestly stopping the market from hitting its full potential.
And that brings us right to the heart of the matter. What exactly was this wall that the market kept running into? And why did it get to the point where new regulations were the only answer?
The whole problem really boils down to one key idea: market liquidity. Now, what is that? Well, think of it like this. Imagine a huge, bustling city market versus a tiny, quiet village stall. In that big city market, it's super easy to buy or sell whatever you want, right? Because there are tons of buyers and sellers. But at that quiet stall, it's way harder. Stocks are kind of the same way. So the challenge in Sri Lanka was really simple. There just weren't enough shares available to trade. This low liquidity meant that if you owned stock and wanted to sell, you might really struggle to find a buyer. And if you wanted to buy, good luck finding a seller. That kind of friction, well, it just stifles growth and makes people hesitant to invest.
But now, there's a plan. Some of the key institutions have come together and stepped in with a collaborative solution, and it's designed to tackle this liquidity problem head-on.
And this wasn't just some idea from one group. We're talking about a joint effort here. The main regulator, the SEC, and the Colombo Stock Exchange, the CSE, they got together on this. And their big solution? To change the rules for what's called the minimum public holding, which is basically the percentage of a company's shares that have to be available for the public to buy and sell.
All right, so how does this new framework actually work? Let's get into the nitty-gritty. So these new rules are aimed at a very specific group: companies that go public using a method called listing by introduction. Now, you can think of this as a way to get your existing shares onto the stock market so people can trade them, rather than the more common way of creating new shares to raise money. And this applies to companies trying to get on the exchange's two main tiers. Now, this right here represents a huge shift. Before, a company had to meet that public ownership requirement from day one. No exceptions. But now, the floodgates are kind of open. They can actually list with zero public holding to start with. That is a massive, massive change. And they've set up this new, really flexible timeline that gives companies an 18-month runway to get everything in order. So they can go public, take a whole year to get to 50% of their public ownership target, and then they have another 6 months after that to become fully compliant.
Okay, this next part is absolutely crucial for liquidity. In the past, insiders, the non-public shareholders, were locked in. They couldn't sell their shares for the first 6 months. Now, the cage is open. They can start selling small portions of their shares right away, which slowly and steadily increases the supply of stock that's actually out there to be traded.
But of course, all this new flexibility comes with some guardrails. You can't just have a free-for-all. To prevent a sudden flood of shares from hitting the market, shareholders have to have owned their stock for at least 18 months before the listing. And a pretty big chunk, 30% of their holdings, stays locked up until the company is fully compliant. It's all about finding that right balance. And to make sure everyone is playing by the rules, this new flexibility is balanced with some strong oversight. Companies have to be really transparent about how they plan to comply, and there are very clear penalties if they miss their deadlines. It's all about maintaining the integrity of the market. So after all these pretty technical changes, what's the end game here? What's the ultimate goal? Let's connect this all back to the big picture and what it could mean for the market as a whole. The SEC's own statement really sums up the ambition perfectly. The hope is that this encourages more companies to go public, which in turn broadens who's participating in the market, improves that core liquidity problem we talked about, and ultimately helps the entire capital market grow and develop. So the crucial point here is that this isn't just a win for the big companies that want to list their shares. It's designed to create a healthier ecosystem for everyone. The issuers, the companies themselves, they get a much more flexible path to market. Investors get more choice and better liquidity, and all the market intermediaries, they benefit from a more active and vibrant exchange. It's meant to be a win-win-win. And that leaves us with the big question. Sri Lanka is making a bold bet here, a bet that more flexibility is the key to finally unlocking its market's true potential. But will this gradual release of shares be the right medicine, or could it be a risk that backfires? The answer to that is really going to shape the future of its economy. Thanks for joining me for this breakdown.